and then work through some of the homework problems. Okay, so that used by the end of the next 2 weeks, by the end of the 2 classes, most of the homework problems are done. Okay, you will have done your chapter. Everybody else will have done the other chapters. And if you write down all of the solutions, slap a cover page on top of it, staple it together, submit the homework in as part of the deliverable. Okay, unless you want to do all the homeworks yourself. Do you want to do them as a team, together, or separately? Perfect. Good answer. Yes.
So, team 11, is that like when they present? Is it going to be the Tuesday of the 18th?
No, because the team 10 and 11 have. Oh yeah, you have chapter. Oh, I'm sorry. You're right. Yes, it is going to be the. Sorry, I didn't go far enough. Right. I thought. No, the quiz is up to chapter 9. Right, and then it'll spill over. This will spill over into the midterm. Okay, does that make sense? So then we'll do 10, 11, and then we'll cycle back through. Okay, so team 1 will do chapter 12. So you'll do two PowerPoints and then 2 pieces of the homework assignment. Did that answer your question?
So we're on the 18th, like 10 and 11?
Okay, say that again because I can't hear you from back here.
10 and 11 for
So team 10 and 11, you're going to be doing that for the midterm. You're doing chapter 10 is for the midterm. Okay, it's not part of the quiz. So you won't be doing it on September 4th or September 11th. You're going to come back after the midterm, and then I'll do this again, and then we'll set it up. So you just wait. Okay? Can you wait?
Yeah.
Okay, wait. Okay, so this is the quiz in blue. These are the PowerPoint presentations that the teams are going to do over the next 2 weeks. Okay, so we'll probably have like 4 or 5 chapter presentations next week. The week after, we'll go through it. We'll finish up the homework. The week before the quiz, which is on the 11th. So you should have most of the homework's done. Okay, almost all the homework should be done. You're just going to, when you're not presenting, you're going to make sure you need to be writing, unless you want to do the homeworks on your own. Okay. Is everybody clear? And the homeworks need to be handwritten. Okay, and they need to be legible. And there needs to be a cover page. Okay. And I'll go through what the deliverable looks like. So you need a cover page for the homework. So you got to give me the university. Oops. You got to give me the university. You got to give me the course and the section. Okay? And then you got to tell me it's going to be homework number 1. Okay? And then it's going to be 2. To me, okay? It's going to be from you. There's going to be a date on the bottom. I'm going to staple all of the homework pages together, okay, so I can take a look at them. All right? Yes?
For the homework, so there's going to be a total of 9 questions. Or am I missing?
You know, the homeworks are right here. So on the syllabus, on page, page is this?
I think it's page 4.
Page 4, right here, where it says Tuesday, August 28th. What's today? What's today?
The
Tuesday, August 28th. This is assigned homework. These are the homework problems associated with the chapters. So again, what we're doing is we're distributing the workload across the teams. You're going to be presenting the chapters. You can edit down the chapter presentations, make them concise so that you can talk from them, and I'll co-present with you. And then what you'll do is you'll come in and you'll walk us through the problems, okay, the homework problems. Okay. So probably when you come in, the first thing I would do before you present is to write the homework problems on the board, okay? So that you can walk us through them, okay?
So those are two different chapters for each team. That's what I was just confused.
Yeah,
Okay.
yeah. There's 2 chapters for each team. And I gotta figure out what to do with team 12. So I don't know what we're gonna do with team 12. We may figure out what to do with team 12. And then actually even team 11, he doesn't have a second chapter, but I'll figure out something for them to do. Okay, figure out something to do. So you do 2 chapters. You do 2 sets of homeworks. And then when everybody comes in to do the presentations on the homeworks, or the chapter presentations and the chapter homeworks, you will be responsible for those, okay? But again, when other people are presenting and doing the PowerPoint, doing the problems for the homeworks, you need to be writing those down, okay? So it's PowerPoints and problems, PowerPoints and problems. And that checked off, we'll check that off as part of the deliverable package, okay? Any questions on what the active learning exercise is in regards to the team PowerPoint presentations assigned to by the chapters, and then the chapter homework assignments for each of the chapters, yes.
So I'm in team 5, would we present chapter 5 and chapter 16, or
No.
are we just doing chapter 5 for
Just
this
do
round?
five. And then we'll do chapter 16, that's for the midterm,
Got it.
okay? So then we'll roll right over into that, okay? And then I might redistribute some stuff too, to some of the other teams.
Got it.
Okay. But what happens is the homeworks, there's a lot of homeworks for the quiz, and then the homework sets shrink for the midterm, and they get really small for the final period, okay? Because I want you to spend more time later on in the semester working on the Goldman Sachs investment analysis, okay?
So it says that homework 1 is due the 11th, and the last few
Yeah, you
teams
can
are
push
presented.
that off. I mean, I'll look at your homeworks just to make sure you're on track.
Yeah.
So I'll inspect them on September 11th, but they won't be actually due until the 18th when you submit them with the deliverable. I just want to see that you're doing it, okay? Just like with the pre-test. Today, I would say half the class was done with the pre-tests. I would say the other quarter of the class had some things that were just missing that we'll go over tonight. And there was probably like 25 or maybe even 10% of the class, maybe three or four people that just didn't, they weren't here last week, so they didn't know what they were doing, okay? And they just couldn't do it. Or some people just didn't get around to doing it. But there wasn't a lot of them. Almost all of you did it, which was great. So you're right on track on where you need to be, okay? Are we clear on what needs to be done? Okay, so we're splitting the load here, okay? So I'm gonna, I find my students love to do the book stuff because it's pretty straightforward. They like to follow along, they seem to learn a lot from it, and then I'll teach the application strategy, applied finance, applied economics, which isn't in the book, because the book basically is just a book. It's not application based off 25 years of academic or business experience. And the stuff that we're gonna go over tonight and next week for the midterm, and I'm gonna give you the midterm, I'm gonna go over it, and you're gonna take lots of notes. Okay, I might as well just go through that right now. So what we're gonna do is, on my part, I'll co-present with you, and I'll check your problems and stuff like that for the homeworks. And then over the next 2 nights, 2 weeks, what I'm gonna do is I'm going to go through the quiz, okay? Now the quiz, I don't know about you guys, but I don't like surprises, okay? Do you like surprises? Do you like to show up for work and have a stack of papers on your desk and the boss basically saying you gotta get through those papers by the end of the day? Is that fun? No, it sucks. But if your boss basically comes to you and says, hey, I need you to work on, some stuff for me, and we're gonna work on it over the next couple weeks, and here's the stuff that I'd like you to work on, and then if you want, I'll be available to basically answer any questions that you may have, and I'll also videotape some of the lectures associated with the work so that you're not getting stuck and you can move quickly through the content and not get stuck. Does that sound better? Yeah, totally. So what you want to do is, here's the quiz, okay? There's no tricks here, okay? No tricks. Because again, I don't believe in just giving you, saying, okay, these are the things that are going to be on the exam. Now go study, okay? Some of it will be on the homework, or some of it will be from the book. Anything's totally random, and I need you to go study. And then what I'm going to do is I'm going to test you. And then if you do good, that's great. I'll give you an A and a B. And if you don't do good, I'll give you like a C, D, and a. That doesn't do anybody any good. Okay? So here's the content of the materials that you're going to need to learn from me. So you're going to need to take notes. Okay? And what I would do, this is what I would do. Okay? This is what I would do. Yeah, they're passing them around. So this is what I would do. I would take the exam. Can you pass these around? This is what I would do. Here, take those. What I would do is I would take the exam like this and put it in here like this. Okay? And then on the front of the exam, put your name. Business 305, Principles of Finance, and I would put quiz in class notes, study notes. Quiz in class study guide, okay? And then as I go through the exam, you're going to be writing in the blue book. Basically the notes that you need for the exam, and basically this becomes your study guide. This becomes your study guide. Go, I don't understand, I don't remember what he said, because I don't take notes, okay? My generation doesn't take notes, we just take pictures. I would take notes, and then what you can do is, well, maybe I don't really understand some of the stuff that Professor Souza said, so what I'm going to do is I'm going to go back and review the video, and write the notes in my study guide, and then study from the study guide. And then I'm going to walk in to the exam, I'm going to stick this under my desk with the rest of the stuff, and what I'm going to do is I'm going to do the best that I can on the exam. Okay? That's it. So is that straightforward? Or do you want me to go back to random questions of assessments with basically multiple choice exams that I can send through, and you bring in a Scantron, and you basically multiple guess the answers? Or do you want to learn the content of the stuff that basically we're talking about or not talking about with senior level executives every single day? Probably not. Okay. So don't forget to write your name on this, write the class, write your name, write the date, and write quiz and in-class study guide on the front of it. And don't fill it out, or don't not fill it out and think that you can sneak this thing in to the exam and not think I'm going to know it, okay? And don't cheat on the exam, okay? Don't bring notes, study from the guide, use the videos, do the best you can, and if you do good, you're done. If you don't do good, you got to go back and redo it, okay? And you got to learn the material, and then resubmit it. And if you still don't do a good job, you got to go back and redo it again, okay? You're going to go back and do it until it's perfect, until it's good, okay? That's the way I work. All right? Is everybody clear on what we're doing? Thank you very much. Anybody not get a blue book? Anybody not get an exam? Everybody wrote on the exam? Can you show me the exam? Can you hold up your exam and show me this so that it has written on it? Okay, perfect, awesome. Yeah, don't forget, let me see, that's written. You guys in the back, are you doing anything? I see nothing back there. Okay, get your names on it. You got the quiz written on it. Okay, make sure you write on it so that you know. Okay, got it. Yes, sir. What? Okay, sorry. Because they went through that. Anybody else not get one? All right. You're welcome. All right, don't forget on the Wiley Plus, they have the narrated PowerPoints. And if you want to, they have solutions to the homework problems in Excel. So that's all you got to do is load up the Excel and walk us through the spreadsheet. if you want to do that. But make sure you print it out so you can include it in your homework submission, okay? And they also have problems with the homeworks that they walk you through there. And I got the solutions to the homeworks already posted onto the website, so there's no reason why you should not move through the homework problems. And then you just have to learn them enough to be able to present them to the rest of the class. Okay, so you're becoming the teachers, okay? I can't do all of it myself. It's more efficient for me to run a team of 12 people of 3, 12 teams of 3, than to basically one person do everything. Those days are over. I know you probably have professors that do it, but those days are over. It's distributed learning, it's active learning, it's a flipped classroom is where we're going, okay? And it's more fun. All right, so let's go through this. Go up to yahoo.com real quick. You can go up to yahoo.com. Go up to yahoo.com and click on finance. And you all have computers, you all have cell phones, you all have tablets. This is a total interactive class. You are basically the trading division for my company. Basically, this is a 5 o'clock meeting in the morning because the New York opens at 6 a.m. So it's our 5 o'clock meeting, and you're going to be back at your desk in 30 minutes to basically place the trades. Because when the bell goes off, that's it, okay? That's it. So this is the morning briefing session, okay? And I need you to give me the information. I need to know what the Dow Jones Industrial Average closed at today. It opens at 6 on Pacific time. It closes at 1. Okay, it's based on Eastern Standard Time. They open at 9. We open at 6. At the end of the day, for us at 5 o'clock, basically when we wake up and when our stock exchange opens in the morning, London closes. And then when, in the morning, when we get to the office at 5 o'clock in the morning, Tokyo is closing. So we can trade, our company trades 24 hours a day. Out of London, New York, and Tokyo, and maybe even Shanghai, okay? So we have offices all over the place. So what I need to do, I'm the managing director, I need to know what the Dow Jones Industrial Average closed at today. And if you go to your Yahoo Finance, all of the numbers are right here. So here's the Dow Jones Industrial Average right here. I'm going to ask you what that is. Here's a barrel of oil right here. I'm going to ask you about that. And then the other is gold, which is right here, trading at an ounce per ounce. Here's the 10-year Treasury yield. And if you go back here, it's going to give you the currencies. It's going to give you the pound to the dollar and the US dollar to the yen, and I like to look at the dollar to the pound and dollar to the euro. Okay, so you may need to go find that. So what did the Dow settle at today? What did it close at? You're all going to be invested in stocks. You're all going to be invested in stocks. So you might as well start tracking the stock market. So where did the Dow Jones Industrial Average close at today?
$26,064.
Was it 26 or 28? Was it 26?
26.
26,000? Okay, great. Where was it last week or 2 weeks ago? Click on it and go back and click the chart and go back 1 day, 1 week, 1 month, 1 year, 3 years, whatever. Tell me what it did. Are we up or down? Are we in an upward trend or a downward trend? The stock's been going up or down? They've been going up, okay. Give me 2 reasons why they've been going up. Okay, you're going to need to go do some research and start finding out, and I'll teach you this too, what the factors are that drive stock prices up and down. Gold prices up and down, oil prices up and down, bond yields up and down, and foreign currency and US dollar up and down. There's really 2 things that drive stocks up and down. One is earnings, expectations, earnings growth, expectations, profitability, sales, revenue growth. It's one, the other, interest rates. If interest rates are low and falling, then stock prices are going to go up. If revenues are increasing, stock prices are going to go up. If interest rates go up, but revenues and earnings go up faster than the increase in the interest rate, stock prices are going to go up. But if earnings expectations are going down and interest rates are going up, the market's going to correct. Okay, and that's bad. Okay, the next is oil. What's a barrel of oil trading at today? What's a barrel of oil? You need to be looking at your computers. Don't look at me and don't look around. You need to be engaged in the terminal, okay? Because your generation has these terminals in front of you and all the information available to you. So where's a barrel of oil trading today?
68.53.
Excellent. Where was it last summer? It was like 38. Oil prices are up 50%. It now costs me almost $5 for premium gasoline to fill up my Audi. Now it's costing me like 40 to 60 bucks to fill it up. Okay, so oil prices went down. Oil prices have gone up. Oil is the #1 consumption good for industry, and gasoline, and everything you own has petroleum-based products embedded in it. Okay, so gold is a major input into consumption and production. Where is the price of gold trading today per ounce? And is it up or down over the last year? Is it trending up? Is it trending down? Is it trading sideways? What is it? What is? It's trending down. And what's the price per ounce? What is it? 1,200, around there? Yeah, okay. So if it's trending down, can you give me one reason why gold, which is a commodity, and as a reflection of inflation as a commodity, why, if the prices are going down, what does that tell you about commodity prices? Are they going up or going down if gold is going down? If gold prices are highly correlated to inflation in the consumer price index, the producer price index, if gold prices are going down, what does that tell you about inflation?
It's going.
It's going, if gold prices, which are correlated, positively correlated to inflation, if gold prices are trending down, what does that tell you about inflation? It's trending down. Okay. The next one is the 10-year Treasury yield. Where is the 10-year Treasury yielding right now? The 10-year Treasury yield is used to benchmark the cost of your student loans, personal loans, auto loans, residential and commercial mortgages. The 10-year Treasury yield is used as the base rate to price all of those mortgage costs. Where is the 10-year Treasury yielding today? What is it? 28.84, so almost 3%. If you go back maybe 3 years or 5 years or 10 years, the 10-year Treasury is almost double what it was. It was around 1.5% during the financial crisis. Now it's almost 3%, and some people are forecasting it to go to 5% at some point. If it goes to 5%, your mortgages are more expensive, your student loans are more expensive, your personal loans, your car loans, everything becomes more expensive from a cost of capital standpoint. Okay. Now, where is the dollar to the pound? Dollar to the pound and dollar to the euro. How many dollars does it cost me to buy a pound or to buy a euro? Can you look that up? Yes, yell it out.
1.26.
1.26, and that's what, is that the dollar to the euro?
No, that's the pound.
Dollar to the pound? 1.2 or 1.6? I got 1.6. 1.16 for the dollar to the pound? Dollar to the euro, 1.16. So it cost me $1.16 to buy a euro. Okay, $1.16 to buy a euro. Okay. Question: is it up or down? It went down. Okay, so it costs me less to buy a euro now. It costs me less. So the question is, why? Why? Because the euro is probably depreciated. It's probably depreciated. Okay. All right. So let's go through that. That's it. I'll go through the exercises on that too. So let's go to, we did the market updates. The statistical pretest. Go to page, the statistical pretest. Go to, and don't forget to put in the definitions and the distributions. I saw a lot of you put the diagrams in there. And don't forget to show me what a median looks like. So give me sort from high to low and pick the midpoint and show me a median. And then with the mode, it's the most recurring number. So show me a bunch of numbers that are recurring and tell me what the mode is. Okay? Skewness, kurtosis, recurrent, histogram, stem leaf, box plots, variance, standard deviation, confidence intervals. Those things are all easy. Confidence levels, 99, 95, and 90. I'm sure you have those. The Z, the T, and the F statistics. The T statistic measures the statistical significance of the independent variable and its capability to predict the dependent variable. Boom. The F statistic is the statistics that measures the model's capability, the model itself of the independent variables, its statistical significance in its ability to predict the dependent variable. Okay? Coefficient of variation is the standard deviation divided by the expected return. The inverse, which is the risk-adjusted rate of return, is the expected return divided by the standard deviation. So it's the flip, okay? The covariance, right there in the back, and as you can see, the covariance, is that correct? Is that covariance correct? Can somebody check that?
I have something different.
Is that right? Okay, perfect. And then there's the correlation right there. And as you can see, the correlation coefficient, which ranges between +1 and -1, as you can see, the covariance is part of the correlation. And the covariance divided by the two stock standard deviations normalizes basically the equation and bounds it between positive and negative. So the correlation is the covariance standardized by the two standard deviations. And you're going to see this all the time as you start to work your way up and do more advanced finance and quantitative analysis and stuff. You're going to see that we're going to be using standard deviations to normalize data, to normalize it, to risk adjust it. Okay? And then a positive correlation. I got two stocks. They're perfectly correlated with each other. I got two stocks perfectly correlated with each other. This is over a 2-year period. This is the total return on the stocks. The correlation coefficient between the two returns go like this. Is that positive, 0, or negative correlation? Are the two stocks highly correlated to each other? Yes or no? Yes, they're almost perfectly correlated. So this is the correlation coefficient. It's going to be +1 or 100%. Okay, got it. Then, if I have two stocks within my portfolio where the returns are like that, what's my correlation coefficient? -1. Got it. -1. And if the correlation coefficient is 0, boom, it looks like that. Okay. Now, if I'm building a stock portfolio and I want diversification within the portfolio, I want to add stocks to the portfolio whose correlations in the returns have low, no, or negative correlation. Okay. Low, no, or negative correlation. So I want either this one, I want the inverse, or I want the correlations to be something like that. So low, no, or negative correlation gives you portfolio diversification. Can somebody put up the, oh, there it is right there, portfolio standard deviation. Awesome. Let's go back over here real quickly. So the portfolio standard deviation. If I add, test question, if I add stocks to the stock portfolio whose returns have a very high covariance correlation to each other, if the returns have high covariance or high correlation to each other, what happens to the risk of the portfolio, the standard deviation of the portfolio? The covariance of the correlation goes up. What happens to the risk of the portfolio standard deviation? It goes up. And if the correlation goes down, and the covariance goes down, what happens to the risk of the portfolio? It goes down. positively, related to each other. The relationship is positive. Okay? You're all gonna be portfolio managers. Okay? So we talked about coefficient of variation, we talked about covariance, we talked about correlation coefficient, we have the portfolio standard deviation right there. There's a couple ways to draw it, but that one's correct. We talked about high covariance and the impact on the portfolio standard deviation, which is at the bottom of page 7. The value of using regression techniques. How are you doing? Am I doing pretty good? Can you follow me?
Mm-hmm.
Okay, awesome. What's the value of using regression techniques? Tell me, why would you use regression? You all eval. Use regression to forecast. If you can build a regression model in forecast, and your forecasts are accurate, do people like you? Your clients, your boss, your senior management. Yeah, because if you can forecast the future, you can forecast when things are going to be good, and you can forecast when things are going to be bad. Okay? And that's what we do, we build models. Okay? And the regression equation should look something like this. What's this? What's y hat? What's y hat? Quick one. What's y hat in a regression equation? What is this? You all wrote down the regression equation, didn't you? So what is y hat? Okay, if you know, yell it out. If you don't know, say I don't know when you tell me Professor Sousa, so I'm not wasting my time. What? Okay, so this is the dependent variable. Okay, that's what you're trying to estimate. Okay, and what's this? Anybody know what that is?
No.
Not yet. What is it? What'd you say? It's the alpha. Got it. Plus, what am I gonna add? What's the next variable? It's the beta coefficient. Excellent. And then what's next to it? Say it. It's the independent variable. Is that a simple regression equation? Is that a simple regression equation? Is that a one variable regression equation? Can I run the regression just based off of the two variables? Can I run that regression? Can I get an error term? Right? Is that right? Yes? No? Yes? No? Yes? So what you're doing is you got basically a plot like this. This is the alpha, that's the intercept. When you run the regression, it basically puts the line through the data points in a linear regression. Okay? And then the error term, here's your regression line, and here's the errors. Dispersion, mean squared errors. These are the errors. So the errors between the line and the actual data points is this. The slope of the line, the beta coefficient. These are the actual data points. And then the intercept is this. Boom. There's your regression. Okay? We use regression all the time. What you'll do is you'll probably do a 5-variable model. I'll let you guys do that. Okay? Show me a 3-variable model or a 5-variable model. Show me this regression equation here in your statistical pretest. So yes, regression is extremely important because you're going to use it all the time to be able to forecast returns on the stock, to forecast revenues, to forecast sales, to forecast profitability, forecast returns. You use regression. Okay. Cross-sectional regression analysis. We're going to do a 2-variable model here. 2-variable. Hat x 2 plus error term. Here's my regression on my multiple regression model. Cross-section. Cross-sectional regression, one period of time. One period of time. Okay? 2018, trailing fourth quarter. One period of time. And then the sample is going to be company 1 all the way through company N. Okay? So if I know I have the variables, I know the dependent variable, I can run the regression to get the coefficients and the error term. So I'm doing this basically for a bunch of startup companies in the same industry, and I'm running the regression equation so that I can predict what the return is on the stock or I'm trying to forecast price to earnings per share multiple, I might be doing that too. Okay. So that's a cross-sectional regression model. You use that with startup companies, because most startup companies don't have 5 or 10 years worth of data to run a time series regression. So basically what I do is to get the coefficients so that I can do the forecast, is I gotta run it against other companies to get the coefficients. And then what I'll do is I'll take my company's data and I'll pump it through the regression model, and I'll be able to forecast my price earnings ratio, my stock returns, our sales by using the cross-sectional regression. But if I'm looking at IBM, or if I'm looking at other companies, Oracle, Intel, that have been around for a long time, what I'll do is I'll run the time series, do my quarterly data, Q1, right, all the way through Q1, maybe 2016, Q1, 2018. So I'm doing time. So now it's not a bunch of companies, I'm doing one company. So this is Intel. And these right here are probably sales. And this could also be, what else is important for forecasting returns on the stock? Maybe sales, maybe growth, and GDP. Macro factor, along with maybe an internal variable for the company. And I'll be able to run the regression, get the beta coefficients, and then what I'll do is I will forecast GDP, I will forecast our sales, and it will pump out the stock returns over here for the company. So I can use the regression. I can use cross-section, and I can use time series. And when you're doing startup companies, they don't have enough history, so you use cross-section until you have enough time data to be able to run the time series. Okay. So what we're doing, what we're studying here, is basically quantitative finance. What are the dependent and independent variables? Dependent variables are what your boss wants you to forecast. I want you to forecast the return on our stock. I want you to forecast sales. I want you to forecast production. I want you to forecast profit margins. I want you to forecast leverage. I want you to forecast something. They will tell you what you should be forecasting. And then, what are the independent variables? These are the independent variables that predict the dependent variable. Okay? And they're going to know, your bosses and people who have experience in the industry and in the company will know what variables should be in the model. Okay? And sometimes they'll ask you to go see if there's any other variables that we don't know about that should be put in the model. And you got to go to the library and you got to read through about 100 peer-reviewed journal articles to see what the academics have done. Okay? To see where the theory is. How do you select and determine the variables? Dependent variable is the one you're trying to predict. It's the one that your boss is telling you to do. How do you determine the independent variable? Well, you ask people, what do you think is going to drive sales? What do you think is going to drive stock returns? What do you think is going to drive the price earnings multiple? What do you think? You've been doing this for 20 years? You tell me. Okay? And then you go, that's internal validation. Then you go, okay, now I'm going to go to the library and I'm going to look up in the Journal of Quantitative Finance and Journal of Corporate Finance, and I'm going to find all the articles that have been written on how to predict stock returns for high-tech startup companies or high-tech companies. Or how do you predict production? How do you predict sales? How do you predict revenues? How do you predict earnings? Okay. So you're going to find it in the journals too. How do you test the variable in the model's statistical significance? We already know that. The model's ability to predict independent variables' ability to predict the dependent variable is used through the F statistic. It's the F stat, which is the model variable. And if you're getting a 5, that's pretty good. If you're getting an 8, it's really good. If you're getting a 13, that's too good. You got multicollinearity. you have variables in your model that are highly correlated to each other, and they're messing up your model. So something in here probably more realistic, because your models can't be perfectly able to forecast the future. So you're fitting the model by putting variables in your model that are highly correlated to each other and correlated to the dependent variable. This is the stuff that's not in the model. It's the stuff I learned over the last 25 years. The other is the T statistic. The T statistic is going to measure the statistical significance of the independent variable to basically predict the dependent variable. So that's the T statistic. And the T statistic ranges between plus and minus 2. If you're getting a 2 plus or minus, it's too good. Okay? Something around 1, 1.25 is plus or minus is good enough. There's other measures. You can use the adjusted R-square, which is your correlation, the overall model's correlation with dependent variables. You can use that. T statistics. You can use Watson if you do time series. There's all kinds of regression diagnostics that you'll learn and become comfortable with when you start building these types of models. Okay? And if you don't know how to build the models, you just ask people, I don't know how to build it. Can you help me build it? Yeah, I'll show you how to do it. And they'll train you how to do it. What is multicollinearity? The problem with multicollinearity is that I have two variables. I have two variables in my model that are highly correlated to each other and correlated to the dependent variable. I don't need the two. I just need one. Okay? And this is especially important when you have 5 variables in your model. So I got 2 out of the 5 variables are highly correlated to each other and correlated to the dependent variable. I got to get rid of one. Which one do you get rid of? Test question. Which one do you get rid of? Okay, this is the art of model building. Which variable do you get rid of? Test question. Do you get rid of the variable with the lowest T statistic? Or do you keep the variable with the highest T statistic? Do you throw out the variable that hasn't been cited as much in the peer-reviewed journal literature? Or do you keep the one that's been cited the most in the peer-reviewed journal articles and also is positively or negatively correlated to the dependent variable? What's the answer? Which one do you keep?
The one that's widely cited?
Exactly. You keep the one that's most widely cited within the literature, because the research has been done over time on different samples, and that variable pops up every single time. Yeah, go
So,
ahead.
when I was thinking, the process using the alpha is under a certain amount and keep it, or is that
No, I'm
just
using the T
completely
statistic. That's different.
Okay.
That's different. So when you're testing the statistical significance of the independent variables, you're using the T statistic. But I got a problem. I got multicollinearity. I got 2 variables that are highly correlated to each other and correlated to the dependent variable. I got to get rid of one of them. Which one do I keep? The one that's cited the most in the literature. Okay? Not the one with the highest T statistic, or the one that has the highest correlation with the dependent variable. Okay? I'm giving you some secrets here. Okay? What's internal and external validity? Internal, I just told you how to solve multicollinearity. Internal validity is basically, I got to build a model. I don't know how to build it. The first thing I'm going to do is the person that asked me to build a model, I'm going to ask them what variables they think should be in the model. Then I'm going to go talk to people within the firm that have experience in this industry sector, and I'm going to ask them, what do you think drives that variable, and get a survey from them and use a qualitative approach. Then I'm going to use external validation and validity. I'm going to go check the peer-reviewed journal articles, and I'm going to find the independent variables through the independent research, and then I'm going to combine the 2 sources and build the awesome predictive model. And I'm going to use internal validation and external validation to justify the variables that are in my forecast model. Because in the presentation to the board of directors and senior level managers, they're going to ask you, how did the model do? How did you pick the variables? What were the diagnostics? What were the correlations? What was the T-stat? What was the F-stat? They're going to frickin' grill you in the presentation. And you got to be right there saying, you know, pick the ones with the highest T statistics. I had some multicollinearity. I threw the one out that didn't have, wasn't cited the most. I kept one in that was theoretically internally and externally validated, and this is the model that I built, both on internal validation, external validation, and the diagnostics. Basically said that this was the best model, and I back tested the model, and it did a good job. And I forward tested the model, and it's tracking. So therefore, based on my recommendation and my forecast, I recommend that you implement this policy going forward. And if you're right, you get the bonuses, you get the promotion, you get all that stuff. Okay? What's the difference between unsystematic and systematic risk? Basically, it's the graph, right? Basically, I'm building a portfolio, adding a bunch of assets to the portfolio. The returns on the stocks that I'm putting into the portfolio, as I add more stocks to the portfolio that have low or no correlation in the returns, it's going to lower the unsystematic risk, the business-specific risk, to a limit. It's going to reach a limit. So that the only thing that's left is the systematic risk. So this is the risk. Can I diversify away political risk in the United States? They built a portfolio or a company. Can I basically hedge off and avoid the potential political and policy risk coming out of the current administration in the two houses of Congress? Can I diversify that away? Can I diversify political risk? Can I? Can I control what Donald Trump does and the two houses of Congress do? No. So that's my systematic risk. If my stock is traded on the New York Stock Exchange and we go into a correction, do you think my stock price is going to go down if the whole stock market is going down? Yep. So can I hedge off that systematic or that market risk? Because our stock is traded on the exchange and most of the stocks on the exchange go down. Can I hedge that off? Can I do something about it if I'm a senior level executive within the company? If the market is correcting and all the stocks are going down, can I stop it? It's systematic risk. Got it. If the economy is falling into a deceleration and falls into a recession, can I do something about it as a manager? That's systematic risk. Economic risk, market risk, political risk, policy risk, are all systematic risk, and you can't diversify that away. And that's called the beta. Okay. And when we learn about the capital asset pricing model, which you already did, systematic risk, the market risk is reflected by the beta. And the beta is basically a measure very similar to the correlation coefficient. Okay. Is this all being confirmed with what everybody has seen?
Yes.
What type of risk can be diversified away from systematic? Pretty simple. Assets and liabilities, you know what they are, they need to equal each other, don't they? Don't assets and liability need to equal each other? Absolutely. Do you want to match your short-term assets with your short-term liabilities? Do you want to use short-term liabilities to fund short-term assets? Yes or no? Yes or no? Short-term liabilities to fund short-term assets? Yes or no? Yes, no? Yes. Got it. Medium-term liabilities to finance medium-term assets? Yes or no? Yes or no? Okay, here's the way it works. If you say nothing, you're wrong. Okay? You're 100% wrong when you say nothing. If you guess, you have a 50% probability of being correct. Okay? So even if you say yes or no, you have a 50% probability of being right. If you say nothing, you have a 100% probability of being wrong. So do you use medium-term liabilities to finance medium-term assets? Yes or no?
Yes.
Do you use long-term liabilities to finance long-term assets?
Yes.
Got it. Corporate income statement, also called a pro forma income statement if you forecast it. Cash flow statement tells you where the cash flows are coming from. Coming from earnings, coming from raising debt. Yes, sir.
Balance sheet, do we need tabs, like correct,
Pardon me?
on the balance sheet?
Yes, make sure you have your owner's equity. Yes, make sure you have owner's equity. And then you have the financial ratios, which are pretty straightforward. These are ranked in importance. Okay? So as a stock investor, I I care about return on equity, ROE. I care about return on assets, but I care more about ROE. I care about leverage, debt to equity and debt to total market cap. And if those numbers are high, you're probably juicing my return on equity. And if you over-lever the firm and we go into a recession, you could risk the company of going into bankruptcy once you default on the bonds. Because there's not enough money to pay the interest on the coupon bonds or the principals when they come due. Okay, and we're gonna learn about that. The price earnings ratio, well, if I take the price earnings ratio, or the multiple, and multiply it by a forward-looking earnings per share, or multiply the two, I can come up with the intrinsic value of the stock. And if the intrinsic value is higher than the current stock, do I buy it, hold it, or sell it? If I take the forward earnings per share, multiply it by a forward multiple, price earnings multiple, and I get an intrinsic value using the multiple approach. If the intrinsic value that I come up with is higher than the current stock price, do I buy it? Yes or no?
No.
No.
Okay, the value that I'm getting from the multiple approach is higher than the current stock price. Do I buy the stock? Because I think the value is higher than the current price, so I buy it. And if the intrinsic value using the multiple approach is lower than the current stock price, do I buy it or sell it? Sell it. Get it? Okay, so these are related. Weighted average cost of capital, you'll learn, that is gonna be called the discount rate that you're gonna use in the discounted cash flow methodologies to come up with the present value, which is another methodology. And then the capital asset pricing model is the model you use to come up with the cost of the equity. Okay, but then you would divide in earnings per share or the dividend to get basically the valuation for the stock. And we're gonna go through all of this. Okay, there's your pre-test. Okay. Did anybody do the 25 stocks? Anybody do those? Oh, you were awesome. Okay, perfect. So what you want to do, I'll show you how to do it. This is not required right now, but I'm going to, for those of you who did it, you guys are totally on track for startup, basically. Okay, so if you go up to the course website, you go right here, stock portfolio worksheet. Okay, stock portfolio worksheet, you click on it, you pull up the Excel spreadsheet. Make sure you pull it up in Microsoft 365. Do not use Google Share on it because you'll blow up the spreadsheet. Okay, so once you pull up that spreadsheet, what you want to do, you want to go, can you guys see this? Or should I turn off the lights? Can you see this? Do you have it up? The spreadsheet is Business 305 Investment Stock Portfolio version 1.2. Is everybody finding it? It's on your course website. It's right here. Go to the course website, it's right here. Right here. Right underneath the memos. Okay. Basically, you pull it up, and it's a really simple spreadsheet. Do not screw up the spreadsheet. Okay? So it's really simple. You go right here to the master target portfolio. That's where you start. Okay? And then what you do over here, what you do over here is you put in the stocks right here. And they all have to be listed, either on the NASDAQ exchange or the New York Stock Exchange. So what I did was I numbered them here. I identified which ones were US and which ones weren't. And I basically built a portfolio. Okay, these are the stocks. Now I'm going to invest in the 25 stocks that I picked. And what I did was I segmented them. So these are tech stocks, these are my defense stocks right here. These are my consumer products right here. These are also, I got Kellogg, Nike, Estee Lauder, Hershey, ConAgra, Procter & Gamble, these are consumer products, and this is a defensive portfolio with some tech and defense. And then here I got Netflix and Starbucks, and I got Visa, MasterCard, JP Morgan, some financials. So what I did was I segmented the stocks by industry sector. So I put in the stocks, I put in the industry sectors, I found the ticker symbols, and I found the stock price as of January this year. So I put the stock price in as of January, okay? Then what I did is I went over here and I put in the value of the equity of the company. It's called the market cap, the value of the owner's equity. It's the stock price times the shares outstanding, okay? So I put that market cap, market capitalization, market value of the equity. Okay? And I could have used revenues or sales if I wanted to as the scaling factor, but in this case we used the value of the equity. Okay? So then I put in the value of the equity in billions, it added them all up, and then we divided them all back, and we got the percentage. So this is the allocation for these stocks within the portfolio based on the market capitalization. You're done. Can you do that? Is that hard? No, it's totally easy, right? So I'm giving you a hypothetical $1 million. So for example, I take 4%, I multiply it by the $1 million, I get the total aggregate value, I divide it by the share price, and I get the number of shares. That's already programmed for you. So that's all you have to put in is you segment it by industry sector, put in the name, put in the sector, put in the ticker, put in the price, you put in the scaling factor, either revenues or the value of the market capitalization, and then it calculates everything for you. Okay? Then what you do is you go to this next slide right here, and I would use January right here. This number here in the target portfolio, I would do January. And then what you do is you go from not January 2018, you go January 2017. And you basically put the prices in here for 2017, and it will calculate the rate of return on your portfolio. And what we did was we actually went back and we calculated what the return has been on the S&P 500 from January of 2018 to January of 2017. And as you can see, my portfolio did 25% rate of return from January of 18 to January of 17. The market did 18. I did 6.8% better than the market for 680 basis points. We killed the market. We beat the market. If you can beat the market consistently over time, you are going to get billions and billions of dollars that will come into your portfolio, and you will make 1% on the assets under management, and you will be a multimillionaire living in Tiburon. Okay? If you can get 20% rate of return every year, your money's going to double in less than 4 years. If you get an 8 to 10% rate of return per year for the next 10 years, your money's going to double in less than 10 years. So your goal is to basically get 8 to 10% rate of return per year for the rest of your life. And if you're really smart and you need to work and save your money, if you save $1,000 a month, okay, $1,000 a month for 40 years, and you get an 8 to 10% rate of return, you will have $4 million in the bank account by the time you're 56 years old. 8 to 10%, $1,000 a month, 40 years, over almost $5 million. Okay, is that easy math? Save $1,000 a month, get 8 to 10% rate of return, and do it for 40 years, and you will be a multi-millionaire. Okay, a multi-millionaire. And you'll be able to take care of your kids and send them to USF and Stanford. So then you go to this back test, 3 years. You put in the stock price as of January 3 years ago. It will back test it. As you can see, how did I do on this one? see, the market did 9.8%, we did 17% per year over the last 3 years. We crushed the market, we did 7.22%, more than the market per year for the last 3 years, or 722 basis points. We crushed the market, okay? And then what did I do over the last 5 years? So I go back and I stick in the prices for January 5 years ago. Boom, put them in there. It calculates and back tests. My portfolio over a 5-year period did almost 19% per year, where the market did 12. We did 6.5% better than the market per year, or 653 basis points. That's our alpha. We crushed it. Okay. And then I go back one more, and go back 10 years, put in the 10-year prices, and here the market did 7.4% per year in the last 4 years, 10 years. We did 13.4. We beat the market by, it looks like, almost 6 percentage points per year, 600 basis points. There's your exercise. So get in your teams. This is not going to be required for the quiz, but you should get it done as soon as possible, because once you build this portfolio, I will give you some technology to start trading and see how you trade, so that by the end of the semester, you've not only back tested your portfolio to see if it's worked, but also you start trading the stocks and see how you do. Okay, but this is really the requirement here, is to teach you how to build a portfolio and then back test it. Okay. And then what you want to do, and then I'll be done with this portion, is you want to go up here. This is the front test after the portfolio. After you finish the target portfolio, the front test here, where you put in the prices as of March, okay? So we're not forward testing your portfolio. So we're gonna calculate, we're gonna put in here the prices as of March. I already calculated the 3-month return for the market. We did 6.8, the market did 5.8, okay? From January to March of this year. And then the last one is the forward test 2, where I put the numbers in as of June. And then we calculate the performance of our portfolio against the market over the last 6 months. And we see how we do. The market only did 0.1. We did 2.2. We beat the market. So consistently over time, we beat the market. If you can do that, you're done. You'll be rich. Okay. You might already be rich, but this is how you get rich. Okay. Build portfolios, back test it, invest in it, and then trade the securities. Okay. If you're good at that. If not, this is just a good buy and hold strategy. Build the portfolio and let it ride for the next 40 years. Okay. And you'll probably do really, really well. All right. Is everybody clear on that? It's not, the exercise is not very hard. Okay. So you gotta be really careful not to mess up the spreadsheet. Okay. And if you go ahead and do that and put those numbers in and then show me the spreadsheet all audited and make sure it's good, and then you're good. Okay. And that'll be extra credit. But this is really important. Okay, so we're gonna do the movie review and then we do the credit quiz. What time is it? 8. And we got what? How much more time? My voice will probably get out at some point.
2 hours.
Okay. So it's 8. I probably got like an hour. Let's take like a 10-minute break so I can get some water to get to the next level. And then what we'll do is we'll go through the memo, and then we'll go right into the exam. Okay, we'll spend like an hour and a half on the exam, another hour and a half. Whatever I get through over the next 2 nights, that's what will be on the exam. And then we'll roll the stuff over into the midterm if I don't get it. Okay, let's take a break. Okay, if you have any questions, come and talk to me.
Order a Coke Zero.
I appreciate it.
Is there a due date for the portfolio, or is that the extra credit?
That's really extra credit. You know, I'd rather have a focus on the quiz. And then as you have more time for the midterm and stuff, shrink everything down. So then you can spend more time on it. But I just wanted to show you how.
Okay. No due date, like.
Not really.
Okay.
Yeah, it's kind of just a flow.
Do you want me to stop the recording?
Yes, please.